Okay, so you want to buy a plot of land, put up some rows of metal boxes with roll-up doors, and watch people pay you every month to keep stuff they mostly never look at again. No employees running around a sales floor, no fitting rooms, no cash registers ringing all day. Just boxes and rent. Sounds like the laziest business model in real estate. Kind of is. And that is exactly why it has quietly become one of the most profitable corners of the entire property industry, and also one of the strangest, because the story of how a self-storage facility actually makes money has almost nothing to do with the stuff people put inside it. Before you make a single dollar, you need to survive building the thing or buying it. And here self-storage has a real advantage over almost every other kind of commercial real estate. You are not building a shopping mall or an office tower. You are building rows of simple steel boxes. Construction costs for a single-story, drive-up facility typically run somewhere in the range of $25 to $70 per square foot, depending on the market, the steel prices that year, and whether the site needs heavy grading. A basic single-story facility on cheap land outside a growing suburb might come in toward the low end of that range. A multi-story, climate-controlled building in a dense city, with elevators, fire suppression systems, and reinforced floors, can run well past $100 per square foot before you've even bought the land underneath it. That gap matters because it tells you something important right away. Self-storage is one of the only real estate asset classes where the cheapest possible version of the product, a bare metal shed with a roll-up door, is still a fully functional, fully rentable unit. You don't need marble floors or a luxury anchor tenant to make the math work. You need a fence, a gate code, and a driveway. Buying an existing facility instead of building one usually costs more upfront per square foot than construction, because you're paying for something that already has paying customers in it, what the industry calls a stabilized property. And that stabilization is not instant. Industry data suggests it can take up to 3 years for a newly built facility to reach a stabilized occupancy of around 85%. That's 3 years of covering your construction loan, your property taxes, your insurance, and your management costs, all while the building slowly fills up one unit at a time. This is the first thing nobody tells you about self-storage. It looks like the simplest business in real estate to operate, and it is, but it is also one of the slowest businesses in real estate to actually start earning real money, because you're not filling a mall with anchor tenants who sign 20-year leases on day one. You're filling 400 separate little boxes, one renter at a time, mostly through word of mouth, a road sign, and Google search results. Like malls, most large self-storage facilities today are not owned the way you'd own a rental house. They're owned through real estate investment trusts, REITs, that spread ownership across thousands of shareholders, while professional operators run the day-to-day business. A small number of these companies dominate the entire industry. Together, the largest handful of self-storage operators, most of them REITs, control well over a third of all self-storage space in the country. That concentration matters because it changes the game for a private buyer. The big REITs can spread the risk of one-week facility in one-week town across a portfolio of thousands of properties nationwide. A private owner who buys one facility in one town is making a much more concentrated bet on that town's population, that town's competition, and that town's economy. So say you've got your facility built or bought and it's slowly filling up. Now here's where the story gets interesting, because the way a storage facility actually makes money is layered in a way most people never think about. The first and most obvious layer is unit rent. Every renter pays a monthly fee for their unit, based mostly on size and whether it's climate controlled. As of recent industry data, the national average monthly rate for a standard 10 by 10 unit sits somewhere around $119, with the blended average move-in rate across all unit types closer to $96. Climate-controlled units, the ones kept at a stable temperature and humidity to protect furniture, electronics, or documents, command a meaningful premium over standard drive-up units, because the operator has taken on extra construction and utility costs to offer them, and because customers with genuinely valuable belongings will pay more not to worry about mold or heat damage. That's layer 1. Layer 2 is the part almost nobody outside the industry has ever heard of, and it's where a huge amount of the actual profit hides. Ancillary revenue. This is everything that isn't the unit itself. Tenant insurance or protection plans, which most facilities require renters to carry, either through the facility's own program or a third-party partner, and which can add another meaningful chunk onto every single renter's bill every single month. essentially for free to the operator, since the facility isn't the one paying out claims. Retail sales of locks, boxes, tape, and packing supplies at the front office, priced the way convenience store items are priced, well above what you'd pay at a hardware store because the renter is standing right there with a truck full of stuff and does not want to drive anywhere else. Truck and van rentals for move-in day. Administrative and processing fees charged once at sign-up, which cost the operator almost nothing to administer but show up as pure margin. None of this requires the operator to build anything extra or hire anyone extra. It's revenue generated from a customer who is already standing in the office anyway. The third layer is the one that makes self-storage genuinely unusual among real estate businesses, and it's called the rate increase, or more specifically, the practice of raising existing tenants' rent well above what new tenants are quoted. Here's how it works. A facility might advertise a 10 by 10 unit for $99 a month to attract a new customer in the door. But once that customer signs the lease, moves their boxes in, and settles into the rhythm of paying that bill automatically every month, the operator will periodically raise their rate, often by notice letter, sometimes multiple times a year, well above what a brand new customer walking in off the street would pay for the exact same unit. This works because of something behavioral economists call inertia, and in the self-storage industry it's sometimes referred to bluntly as the path of least resistance. Moving a storage unit is annoying. You have to rent a truck, take a day off, and physically carry your own furniture and boxes somewhere else, just to save maybe $10 or $15 a month. Most people don't bother. Industry data shows that a majority of long-term tenants, more than 6 in 10 renters who have stayed over a year, will simply keep renewing rather than move out over a rate hike. That single fact, that people would rather absorb a slowly rising bill than deal with the physical hassle of relocating a unit full of stuff they don't even use, is one of the quiet engines that makes this industry so profitable for operators who understand it. A mall depends on foot traffic walking past storefronts to sell products. A self-storage facility depends, in part, on human inertia to sell nothing at all. Now let's talk about the cost side, because this is where self-storage looks almost embarrassingly cheap compared to other real estate. A shopping mall needs enormous common area maintenance spending, cleaning crews, security patrols, escalator servicing, elaborate climate control across 1 million square feet of enclosed public space. An apartment building needs plumbers, maintenance staff on call at all hours, and constant unit turnover work. A self-storage facility needs almost none of that. There's no indoor common area to speak of at a drive-up facility. There's a fence, a gate with a keypad or an app, security cameras, maybe 1 or 2 staff members in a small office, and that's often close to the entire operational footprint. Same-store operating expense ratios in this industry tend to run meaningfully lower than most other commercial property types, which is exactly why storage REITs post some of the highest profit margins in all of real estate, with same-store operating margins commonly sitting in the high 70s as a percentage of revenue. The building doesn't need much done to it once it's built. It just needs to stay locked, lit, and monitored. That doesn't mean costs are zero, though, and this is where new owners can still get surprised. Property taxes on a large facility, especially one that's recently sold or been reassessed at a higher value, can jump substantially and eat into margins fast. Insurance costs across the entire commercial real estate industry have been climbing sharply in recent years, and storage facilities, sitting on open land often near highways, are not exempt from that trend. Payroll, even for a lean staff of 1 or 2 people per facility, adds up across a portfolio. And there's a cost that's easy to overlook entirely until it happens. The unrentable unit. A storage unit with a broken door track, water damage, or pest problems earns exactly $0 a month while still needing to be repaired, and unlike a bad tenant in an apartment, there's no negotiating with a jammed roll-up door. It just needs a maintenance crew, same as anything else. Here's the part of the story that makes self-storage genuinely different from almost every other kind of commercial property, and it explains why sophisticated investors have been drawn to it for decades. The industry is famously resistant to recessions, and in some ways actually benefits from them. Operators in the business have a phrase for the forces that drive demand, sometimes called the 4Ds: death, divorce, dislocation, and downsizing. People need somewhere to put a deceased parent's belongings while they sort out an estate. Divorcing couples need somewhere to put half a household's worth of furniture while they figure out separate living arrangements. People relocating for a new job need somewhere to stash their stuff during the gap between leases. People downsizing into a smaller home or an apartment need somewhere to put the furniture that no longer fits. None of these events wait for a good economy. If anything, some of them, layoffs forcing people to move in with family, foreclosures forcing people out of homes and into apartments, happen more often during a downturn, not less. That's a sharp contrast to a shopping mall, where a recession means shoppers spending less at every single store simultaneously. Self-storage doesn't need people to be doing well. It just needs people's lives to be in motion in either direction. But don't mistake recession-resistant for risk-free, because the structural danger in this industry is not a sudden anchor tenant bankruptcy, the way it is with a mall. It's something slower and less dramatic. Oversupply. Because a storage facility is relatively cheap and fast to build compared to almost any other commercial property type, and because the barrier to entry is genuinely low, a fence, a gate, some steel boxes, developers can and do overbuild specific metro areas when the numbers look attractive. When too many new facilities open within a few miles of each other at the same time, the entire local market gets flooded with vacant units simultaneously, and that pushes rental rates down for everyone in the area, new operators and established ones alike, sometimes for years. This exact pattern played out across a number of Sunbelt markets in the mid-2020s, where a wave of new development collided with a slowing housing market, since fewer people buying and selling homes means fewer people generating that dislocation demand in the first place. Occupancy rates and rental rates across major public operators softened noticeably during that stretch, even as the biggest names in the industry, the large REITs, kept posting stable, low 90% occupancy overall, because their sheer size and geographic spread let them absorb weakness in any one overbuilt market. A small private owner with one facility sitting in the middle of an overbuilt submarket does not have that luxury. If 4 new competitors open near your one facility in the same 2-year window, you're not competing on service or reputation, you're competing on price. And in a business built on thin operating costs and fat margins, a rate war can turn a profitable facility into a break-even one almost overnight. There's also a legal mechanism worth knowing about, because it shows up in almost every state's self-storage laws and it's unlike anything in residential or office real estate. The lien sale. When a tenant stops paying rent on their unit for long enough, typically a period defined by state law, the facility has the legal right to place a lien on the contents, notify the tenant, and eventually auction off everything inside that unit to recover the unpaid rent. This is, structurally, one of the industry's built-in protections against the kind of bad debt that plagues landlords in other sectors. An apartment landlord dealing with a non-paying tenant can face a lengthy, expensive eviction process before regaining control of the unit. A storage operator dealing with a non-paying tenant has a comparatively fast, well-established legal path to reclaim the space, sell the contents, and re-rent the unit to someone new. It's a small detail, but it's part of why the business model holds together financially even with some level of delinquency baked in. So does owning a self-storage facility actually work as a business? Much like the mall story, the honest answer depends heavily on which facility, in which town, at which point in that town's development cycle. In the optimistic scenario, you own a facility in a growing suburb with a housing market that's actively moving, in a submarket where nobody has overbuilt, with a healthy mix of drive-up and climate-controlled units, low turnover, and a loyal base of long-term tenants slowly absorbing modest rate increases. In that world, operating costs stay a relatively small share of revenue, ancillary income from insurance and retail sales adds a steady bonus on top of rent, and the whole thing runs with a lean staff and thin overhead, producing some of the highest margins available anywhere in commercial real estate. This is the version of the story that turned self-storage from a niche, slightly unglamorous corner of real estate in the 1970s into a multi-billion-dollar public market dominated by a handful of REITs that Wall Street now tracks as closely as any office or apartment sector. In the realistic bad scenario, 3 new competing facilities open within a few miles of yours over an 18-month stretch, because the barriers to entry that made this business attractive to you were just as visible to everyone else. Move-in rates across the local market start dropping to attract customers away from the new competition. Your existing tenants, watching new facilities advertise lower prices, start pushing back on renewal rate increases or simply move out and take advantage of a competitor's introductory deal. Occupancy that once sat comfortably above 90% starts drifting down into the 80s. Meanwhile, your property taxes and insurance costs, tied to the value and location of the land rather than how full the facility is, keep climbing regardless of what your occupancy rate says. The building itself doesn't change in either scenario. It's the same steel boxes on the same plot of land. What changes is the local supply and demand balance around it. And in a business this cheap and this easy to replicate, that balance can shift faster than almost anyone expects. At its core, a self-storage facility looks, from the outside, like the emptiest possible real estate investment. No customers walking the aisles, no foot traffic to design around, no anchor tenant whose brand pulls people through the door. But underneath that emptiness is a genuinely clever business, one built not on selling anyone anything, but on too much quieter forces. The unpredictable churn of human life that constantly generates new demand for a place to put things, and the simple, powerful inertia of people who would rather keep paying a slowly rising bill than deal with the hassle of ever emptying that unit out. The building isn't really the business, again. It's the moments in people's lives, the moves, the downsizings, the in-between chapters, that keep those doors rolling up and down every single day.